Hello everyone. Today we are going to learn about chapter 14, weighted average cost of capital or WACC, and chapter 16, financial leverage and capital structure. In the previous chapters, when we want to evaluate a project, we were already given the cost of capital or the required rate of return. In this chapter, we are going to learn how to calculate the required rate of return or the cost of capital itself. Basically, the terms required return, appropriate discount rate, and cost of capital can be used interchangeably because they all mean essentially the same thing. What differs the required rate of return with the cost of capital is only the point of view. The required rate of return is in the shareholders or investors' point of view of how much return the investors of the project or a company desires. The return that the investors require in the point of view for the company or the project is the cost of capital. The important thing to be remembered is the cost of capital doesn't depend on the source of the fund, but rather the uses of the fund. Why? Because the riskier the project is, the larger the required rate of return demanded by the investors. Basically, there are two major components of the WACC, or the weighted average cost of capital: the cost of equity and the cost of debt. However, if the company happens to have preferred stock, the components of their WACC becomes the cost of equity, cost of debt, and cost of the preferred stock. Now we shall look at each component more closely. The first one is the cost of equity. The cost of equity is the return that equity investors require on their investment in the firm. There are two approaches to calculate the cost of equity: the dividend growth model and the security market line, with the formula as follows, this one and this one. As you may recall, the cost of equity using the dividend growth model, this one, is just a rearrangement of calculating the price of the stock with a constant growth in chapter 8, while the security market line approach uses the same formula as the CAPM or capital asset pricing model, which was discussed in chapter 13. Each of the approach has their own advantages and disadvantages. The advantage of the dividend growth model is its simplicity. However, it is not applicable to all companies, especially for the companies who do not pay dividends with a constant growth rate. The cost of equity is also sensitive to the change of the growth rate, and there is no adjustment for the risk within the company. Meanwhile, the SML approach can address the disadvantages of the dividend growth model. However, it still relies on the past data to predict the future, and the cost of equity may result in inaccurate number if we cannot estimate the beta and the risk premium well. Now we are going to move to the cost of debt. Cost of debt can be defined as the return that the lenders require on the firm's debt. For the firm that issues a bond, the YTM or the yield to maturity is the cost of debt. Please note that the coupon is not the cost of debt, so make sure that in the final exam you use the YTM as the cost of debt. Next one, we are going to discuss about the preferred stock, the cost of the preferred stock. For companies that issue the preferred stock, they also have to bear the cost of preferred stock. Just for a quick review, the difference of the preferred stock and the common stock is that the preferred stock will be prioritized for the dividends distribution with a fixed rate of dividends, as well as the distribution of the assets when the company has to be liquidated. As you might recall, the formula is just the rearrangement of the stock valuation formula with no growth rate. Now we move to the formula and the calculation of the WACC itself. This is the formula of the WACC. Notice that for the cost of debt, you need to multiply it with 1 minus TC, which basically means you are calculating the cost of debt after tax. In this formula, RE means the cost of equity, RP means the cost of preferred stock, and RD means the cost of debt. Notice that we have also E per V, P per V, and D per V. These are basically the proportion of each source of fund to the total market value of all sources of the fund. So for example, for the E per V means how much equity comprise the overall market value of the firm's capital. Please bear in mind that in this calculation you have to use the market value, not the book value. Just like I've written here, to determine the value of EV, E per V, P per V, and D per V, we need to sum the market value of the equity, preferred stock, and the market value of the debt. After that, we divide each market value of the source of the fund with the total combined market value. The WACC itself is not perfect and can be troublesome if you want to evaluate investment with risk that are substantially different from those of the overall firm, and evaluate which division we should invest our resources or money in. This is due to the fact that the WACC itself doesn't contain any information regarding the risk of the investment or the division. If we just choose the investment or division we want to invest in just by looking at their WACC, we might invest in a project or division that is far riskier than we can accept, as we tend to choose the project or division that yields a higher WACC, but probably the risk is too much to be borne by us. Okay, so now we are going to discuss about the flotation cost and the WACC. Whenever we want to raise new debt or new equity, this process will also take some sort of our resources. In this case, of course, the monetary amount that we have to pay in order to be able to raise the new debt or the equity. So, for example, if you want to sell additional stock, you have to pay for the underwriting fee, legal fee, and other types of fees um, that I might not discuss here. This is called the flotation cost. The flotation cost can be calculated as follows, as this one. And it is especially important if you want to calculate the NPV of the project, um, since the flotation cost will affect the amount of the real cost of raising the initial outlay. Okay, so now we proceed to chapter 16, financial leverage and capital structure. The big question that we want to address in this chapter is there any optimal capital structure? That is the capital structure that will yield in a minimized WACC. We know from chapter 14 that when the WACC is minimized, such as in the calculation of the present value of the future cash flow, we will be able to maximize the value of the firm or the project. So it is important for us to find the optimal capital structure if there is any. The effect of financial leverage. As you might have already known, financial leverage is the extent to which the company relies on debt for financing their activities. The more debt they have, the more financial leverage they are going to gain. For a clear understanding of this matter, I strongly suggest you to read the book. Here I'm just going to explain briefly. So as you might see from the table, when the company is using no debt, this is gonna be their net income, and this is gonna be their ROE and the earning per share. Um, and under the proposed capital structure, where the company decides to use some debt, the company can generate net income as much as these figures, and then the ROE and the EPS. Notice that in the case the firm decides to go from full equity to incorporate some debt in their firm, by reducing the amount of the equity and convert them into bonds, so the amount of the share decreases and the equity also decreases, which in a sense contributes to the variability of the EPS and the ROE. So when they want to change from no debt to use certain amount of debt, they need to reduce the amount of the stocks. In this case, the case that we use from the book, they're going to have to decrease the shares outstanding and then convert them to the bonds itself. So as you can see here, the ROE and the EPS change. Okay, and the variability can be caused by the decrease of the shares itself and the total equity that the company has. So this illustrates the magnification of gains and losses of the financial leverage. Based on this table, we can conclude that first, the effect of financial leverage depends on the company's earning before interest and tax. When earning before interest and tax is relatively high, leverage is beneficial. Second, under the expected scenario, leverage increases the return to shareholders as measured by both ROE and the EPS. Third, shareholders are exposed to more risk under the proposed capital structure because the EPS and ROE are much more sensitive to changes in earning before interest and tax in this case. And fourth, because of the impact that financial leverage has on both the expected return to stockholders and the riskiness of the stock, capital structure is an important consideration. But is capital structure really an important consideration? The answer is no. Why? Because the shareholders can adjust the amount of financial leverage by borrowing and lending on their own, which in this case, we can refer that to the term of the homemade leverage. We can just replicate the proposed capital structure at personal level. So I'm not going to explain further about the homemade leverage. You can just see your book. Okay, now we are going to move to the central part of this chapter, which is the M&M propositions. The M&M propositions consists of two propositions for each of two conditions, without corporate tax and with the corporate tax. The first proposition of M&M without tax states that the value of the firm is independent of the firm's capital structure. What constitutes the value of the firm at the end of the day is the amount of the asset. So let's see, in this example, um, assume that this is the these two pie are from two identical companies in terms of the total assets. Okay, so regardless of their sources of the fund, whether they use more debt financing or whether they use more of the stock financing, um, the value of the both companies are the same because the value of their total assets are exactly the same. So MMM proposition 1 states that the value of the firm um, is independent of the firm's capital structure. So no matter how much debt or how much equity that you're going to use, the value of the firm, if the total asset is identical, then they're going to be the same. The second proposition of M&M without tax stated that the cost of equity capital is a positive linear function of the firm's capital structure. As you can see from the chart, okay, the higher the debt to equity ratio is, the greater the cost of the equity capital. Why? Because in the second proposition, we have incorporated the risk associated with having more debt, which are the business and the financial risk. So as the firm uses more debt, the cost of equity capital will also increase because the investors want to be compensated because they are going to bear more risk associated with the firm having more debt itself. So why the cost of the equity capital increased. Okay. Now, what if we decide to incorporate the tax in the M&M propositions? We know that the interest we pay for the debt financing is tax deductible. This basically means for two identical companies in terms of the earning before interest and tax, net working capital, and net capital spending, The only difference would be in the interest that they have to pay and the amount of the tax that they have to pay to the government. The company that uses that, or we can call that the levered company, will have to pay certain amount of interest, and it will result in the lower tax that they have to pay. Meanwhile, the company that use 100% of equity, or we can call this company the unlevered company, will not pay any interest and they have to pay larger tax. Plug this number into the calculation of the OCF and CFFA, you will find that the levered company will have a higher value than that of the unlevered company. By how much? By TC, or the corporate tax, multiplied by the debt itself. So notice that in every M&M first proposition, we haven't taken into account the larger risk of having more debt. So the implications of these propositions are like this. The first one is debt financing is highly advantageous, and in the extreme, a firm's optimal capital structure is 100% of debt because of the tax shield we're going to get if we use the debt. And the firm's weighted average cost of capital, or the WACC, decreases as the firm relies more heavily on debt financing. Okay, now we're going to discuss about the M proposition 2. Um, it is basically not that different with that of the without tax condition. This is how we are going to calculate the cost of the equity before we plug the number into the weighted average cost of capital formula. Unlike the case of the proposition 1, the general implication of proposition 2 are the same whether there are taxes or not. Okay, so that means the higher the debt to equity ratio is, the greater the cost of equity capital as the risk also increases. This is basically the summary of the NMM propositions. You can just read that on your book, or you can read that in this slide later. However, we know that the higher amount of the debt the company uses, the more prone they are going to go out of business. What M&M propositions haven't covered is the fact that there is a bankruptcy cost. So there are two new theories emerged: the optimal capital structure and the pecking order theory. The optimal capital structure states that firms borrow up to the point where the tax benefit from an extra dollar in debt is exactly equal to the cost that comes from the increased probability of the financial distress. The proponents of this theory believes that there is an optimal debt to equity ratio and the optimal WACC. Okay. However, if there is this optimal debt to equity ratio, why do many large, financially sophisticated, and highly profitable firms use little debt? Under the static theory, these are the firms that should use the most debt because there is little risk of bankruptcy and the value of the tax shield is substantial, but they still stick with a short amount of debt. This can be explained by the pecking order theory, um, in which the key element is that the firms prefer to use internal financing whenever possible because it is the least expensive way. Okay, if internal financing is not sufficient, the firm will prefer to issue debt rather than the equity. Unless issuing the debt is not sufficient, the firm will prefer not to use any additional equity. Why? Because internal financing doesn't cost you anything. Remember that issuing the debt and equity can be quite costly because you have to pay for the flotation cost, and the cost of issuing equity is larger than issuing the debt because issuing equity wouldn't only cost you the monetary value or the money, but also the dilution and other things that you will learn in the next chapter. So, which theory is correct? Um, the books has already stated that both theories are correct, um, and can be useful in understanding the corporate use of the debt. The optimal capital structure theory speaks more to long-run financial goals or strategies. The issues of tax shield and financial distress costs are important in that context. But the order theory is more concerned with the shorter run tactical issues of raising external funds to finance the investment itself. So that concludes the material for today's session. Now we shall proceed to the questions examples.